Another option is a short sale. And this is when the lender agrees to accept less than what is owed on the property to satisfy a lien. And I briefly touched on it, but there's a ton of challenges involved with short sales. One, there's a lack of qualified buyers, okay? As I said, with regards to selling the property, people can't get mortgages. So there's not a lot of people out there who can actually have the wherewithal to buy the home. Lenders may be unresponsive. It's estimated that only 10% of attempted short sales are approved. So many people are trying short sales, but very few are actually successful in negotiating a short sale with their lenders. Credit damage. Short sales have a very, very negative effect on your credit. Deficiency judgment is again possible. Just like a deed in lieu, the bank may hold you responsible for a deficiency judgment, okay? If you owe $200,000 on a house and you sell it at a short sale for $150,000, the bank may say, you still owe us $50,000. Okay, so it's very serious. Potential tax consequences. Again, just with the deed in lieu, if they forgive that amount, okay, again, if you owe $200,000, you sell the house for $150,000, if they forgive that $50,000, most likely the bank is going to send you a 1099 for $50,000 and you're going to owe the IRS $50,000 on phantom income. Title company may not insure the sale. Title companies don't want to deal with short sales. They make it very hard to go to a closing, to actually affect the sale of a house because title companies aren't participating in short sales. And finally, usually the only person that benefits is the buyer. The buyer's picking up your house for a song. Buyer is picking up your house for nothing. He's the only one that's getting anything out of it. Another option is bankruptcy. And this is a process in which a debtor is given a fresh start and relief from the debt. And this is what I call the nuclear option, okay? And it's a whole entire presentation unto itself, but I'll briefly touch upon it here. In a Chapter 13, which is a repayment plan bankruptcy, if a borrower defaults, the home will be repossessed. So it's not a loan modification. It's not going to lower your payments. And if you fall behind in your payments again, the bank's still going to come in and they're going to foreclose anyway. So the bankruptcy got you nowhere. In a Chapter 7 bankruptcy, which is a liquidation bankruptcy, where you don't make repayments to your creditors, many assets, including the home, are lost to satisfy creditors. In short, if you're behind on your mortgage and you file a Chapter 7 bankruptcy, you can't keep the house. It's not going to help you. You're going to lose the house automatically by default. You may not owe any money, but you're not going to be able to save your house. It's not going to help you in that regard. And then finally, your credit's damaged for 10 years. The bankruptcy will walk around with you for life. It's very serious. Now, federal foreclosure help, and this is something I want to spend a little more time on. You have two options, and the first one is HAMP. This is a government-sponsored refinancing program entitled Home Affordable Modification Program, and it's designed to help struggling homeowners avoid foreclosure by modifying their loans to a level that is affordable. There are some challenges, however. First, you must be delinquent on your mortgage or face imminent risk of default. So if you're struggling to make your mortgage payments, but you're still making your mortgage payments, okay, if you're paying a large amount of your take-home pay just to stay current, but you're falling behind on everything else, HAMP isn't going to help you, okay? It only helps those who are behind on their mortgage already. Number two, you must be occupying the property as your primary residence. Now, in the mid-2000s, when everybody was buying homes, because prices were just increasing at a rapid rate, many people bought second, third, fourth homes. HAMP won't apply, okay? It's only going to help with your primary residence. Your loan balance cannot be greater than $730,000. So again, if you bought your home, in 2005, 2006, when prices were inflated, you may have gotten a loan that was larger than $730,000 for what may now be a fairly modest house in today's market. HAMP isn't going to help you. Fourth, no principal reduction is possible. And I'll go into this when I talk about loan modifications, but a key element of any loan modification is a principal reduction. That's where you get your biggest bang for your buck. That's how you modify your loan down to a payment that's truly affordable. HAMP doesn't provide for principal reductions. And finally, HAMP was expected to help 3 to 4 million people, and today it has only helped 300,000 people. And I think that number is entirely accurate. Very, very difficult to qualify for HAMP. There's kind of a hidden formula behind it. Very few people know how to master it. Very few people fall into the little box that they want you to fall in to qualify for HAMP. Now, an alternative to HAMP, another government program, is the Home Affordable Foreclosure Alternatives Program, or HAFA. This is an option for those who are not able to keep their homes through HAMP. It provides incentives in connection with a deed in lieu of a short sale or a deed in lieu of foreclosure. Again, you've got a number of requirements and make HAFA, have some limited effectiveness. First of all, the borrower must have been in HAMP to qualify. So you must have met the initial requirements for HAMP before you could even be considered for HAFA. So again, you must be behind in your mortgage. You must be able to walk away from your home. HAFA isn't going to help you keep your home, it's going to help you walk away. So it's not an option if you're really trying to save your home. The program will pay you $3,000 to leave, which admittedly probably won't go very far in today's world. And there's no deficiency judgment. So there is some positives to it. You can walk away and not owe anything, which is better than you're probably going to do outside of the federal foreclosure help programs. And finally, we come to loan modifications, which I'm sure is the reason why many of you are here tonight. And this is when the lender reduces interest rate or changes the terms of the loan so they're more favorable to the homeowners. A number of challenges, and I'm sure most of you are familiar with these. Number one, lenders may be unresponsive to homeowners. You send documents, they say they have all the documents, they call you because they need more documents. They lose the documents. They tell you they're going to send you a letter, and the letter never comes. Everybody's got a horror story about loan modifications, and I'm sure we could talk about them for hours. The new terms may be unrealistic for current financial status, okay? Many people are getting loan modifications, but they're not actually lowering payments. In some cases, I've seen loan modifications that actually increase the payments. So who is that really helping? If you couldn't pay your mortgage before, and they modify your loan to the same amount or higher, how are you all of a sudden going to be able to pay for it? It doesn't make any sense. The homeowner's financial situation must be stable. You can't modify down to $1 a month, okay? It's going to be something. Now, if you have some sort of hardship, if you're self-employed and your income goes up and down, or if you're on unemployment, or what have you, there's a whole host of hardships out there, you're not going to really fall into a loan modification that works for you because you still have to make some payment. There still has to be some modified payment that you go forward on, and you may not be able to afford it given your current financial situation. And finally, it's difficult to obtain a principal reduction. And I said this, it's very key. It's a key element. You're talking about loan modifications, you can change the interest rate, you can change the amortization or the time over which you pay for the loan, and then principal reduction. That's where you get the most bang for your buck. But it's very, very difficult to negotiate that with your lender. It makes it very, very difficult to get a modification that really works and really helps you in the long term. In fact, according to the U.S. government Office of the Comptroller of the Currency, more than half of all loan modifications have already redefaulted. And this is within 9 months after the loan modification is granted. So you can see kind of what I'm trying to get across here. People are getting loan modifications. It's definitely possible to get loan modifications, but most people are falling out of loan modifications because they're not going far enough. Okay, they don't take into account the true financial status of the person who obtained the loan modification. So most people are redefaulting, falling back into foreclosure or going into foreclosure, and they're not able to get out, and they're not able to save their home. And why is this? It's because banks are totally and intentionally dysfunctional. The reason they get away with this is because they're dealing with consumers who are not educated in the way things are supposed to work. They just keep browbeating people until they give up and go away. Complaints against Bank of America, and it could be any bank, it could be GMAC, it could be whomever your lender is, accuse the company of failing to provide answers or repeating losing documents, of lying about sending letters that were never sent, and of proceeding with foreclosures while customers are still trying to get modifications. So it's a major problem. These loan modifications aren't doing their job. They're not going far enough. Now I want to talk about some foreclosure scams and schemes that are out there that I think you should be aware about. So-called foreclosure rescue companies have become widespread with promises to help homeowners avoid losing their homes. Unfortunately, many of these companies use questionable, sometimes illegal tactics. The result is often lost money, ruined credit, loss of any equity in the house, and sometimes even losing the house itself. I encourage you all to look at the Illinois Act, and it's called the Mortgage Rescue Fraud Act. Become familiar with that. It's a great act. Lisa Madigan put it into effect a few years ago, and it protects consumers who are looking for foreclosure relief from unscrupulous people. And it's a great, great law, and I think it's done a lot of good. So I encourage you to become familiar with it. Now I want to talk about some of the different tactics you can use to gain leverage with your lender in hopes of obtaining a loan modification and fighting foreclosures. And the first one of these is predatory lending. Predatory lending is when a lender or mortgage broker engages in deception or fraud or manipulates the borrower through aggressive sales tactics or takes unfair advantage of a borrower's lack of understanding of loan terms. Predatory lending has been rampant in the last 78 years. In fact, the Wall Street Journal reported in 2006 that 61% of all borrowers receiving subprime loans had credit scores high enough to qualify for prime conventional loans. So what does that mean? A subprime loan is more expensive, okay? It has a higher interest rate, it has more points and fees attached to it. What they're saying here is that you go back to 2006, during sort of the run-up of the real estate market, mortgage brokers and banks were putting people into loans with higher interest rates, higher fees, higher points, okay, when they could have qualified for a less expensive loan. So fast forward to today, a lot of people can't afford their mortgages, and it's a direct result of having been put in a bad loan in the first place. So it's very key to kind of understand predatory lending and go back to when you got your mortgage loan and think about whether you may have qualified for a better loan, whether everything was disclosed to you, so on and so forth. And as far back as August of 2008, the American Association for Justice wrote, "Fighting foreclosures is the only way to make sure that consumers, especially those who are tricked into loans they couldn't afford, are treated fairly, because the banks aren't going to do it on their own." So you may be a victim of one of these bad loans. You may have been taken advantage of a number of years ago when you got in your loan, but the problem is the bank isn't going to acknowledge that and rectify it on their own. You have to be proactive. You have to take direct action on behalf of yourself if you want to remedy the situation, because the banks certainly aren't going to do it. Another facet of predatory lending is questionable fees. And the New York Times reported an analysis of foreclosures found that questionable fees had been added to half of all loans examined. Now, this could be something as small as a credit report. Okay, they'll pull your credit when you get a mortgage loan. That costs $35. Sometimes that shows up, and I've seen it, shows up on a settlement statement, okay, on your closing paperwork as $100. I mean, there's a whole host of fees associated with getting a house, and I acknowledge that, but many of these fees are unnecessary. Many of these fees are inflated, and they go directly to the bank, they go directly to the mortgage broker's pockets. They don't go to you, they come out of your pocket. So it's very, very, very important that you understand these concepts, because these can help you, and I'll go into further detail how they can help you, but it's very important that you understand that you may be the victim of some of these predatory lending violations.